Welcome back to the ICT or SMC beginners course. Today we are covering fair value gaps. We're going to go over what a fair value gap actually is, as well as what the difference is between a SIBI, which is a sell side imbalance, buy side inefficiency, and a BISI, which is a buy side imbalance, sell side inefficiency. Now, fair value gaps can actually be used for more than one thing. Not only can they be used as an entry point, which is where I take most of my entries from, but they can also be used as a target or a place to partial or close your trade if you're looking to go from external range liquidity to internal range liquidity. And I know that probably doesn't make a lot of sense to you guys quite yet, but I promise in the future it's all going to come full circle and this is all going to click for you. Okay, so what actually is a fair value gap? And the first type of fair value gap we're going to look at today is called a BISI. This is one of two potential types of a fair value gap, and what BISI stands for is buy side imbalance, sell side inefficiency. And I know that sounds a little bit confusing, so for the sake of understanding what it is, essentially it's going to be a bullish fair value gap. That means that price is moving up. Now, any fair value gap is going to require 3 candles in order to determine if it is in fact a fair value gap. And for BISIs or bullish fair value gaps, you're going to need candle 1 to close, then you're going to need candle 2 to trade above candle 1's high, which would be right here, and close above candle 1's high, and then you're going to need candle 3 to trade into candle 2, but not to or through candle 1's high. So as you can see, the gap from candle 3's low to candle 1's high is going to be your fair value gap. So now that you kind of have a base understanding of what a BISI or bullish fair value gap is, let's take a look at this right side where you can see we have the second type of fair value gap, which is called a SIBI, or a sell side imbalance, buy side inefficiency. And to keep this simple, it's also a 3 candle formation, and essentially what we're looking for in order for this to be an active or valid SIBI or bearish fair value gap is we need candle 1 to close, we then need candle 2 to trade to and through candle 1's low and ultimately close below candle 1's low. We then will allow candle 3 to trade into candle 2, but candle 3 is not allowed to trade to or through the lowest point of candle 1. That gap between the high of candle 3 and the low of candle 2, which should only have a body from candle 2 in between it, is going to be your SIBI or your bearish fair value gap. So I'm hoping that that's pretty clear right now, but just so we're all on the same page, for example, if candle 3 was to trade all the way up to or through candle 1's low, as you can see, there's no gap in between this candle's high and this candle's low, and therefore there is no fair value gap. The same could be said for candle 1 on both scenarios, or the bullish example here, just so we can keep moving to either side. If candle 1's wick was really high and candle 3 just traded into candle 2 a little bit, but it did end up trading into candle 1's high, then there is no fair value gap because there is no gap between candle 3's low and candle 1's high, with only one single candle's body overlapping it, which would be candle 2. So as long as there is a gap between candle 1's high and candle 3's low with a single body overlapping it, as you can see like this, then there is in fact a fair value gap. Okay, so are these specific levels that we want to be interested in or looking at, or is this more of an area or zone? And to keep it simple, this is more so an area or zone, but there are specific levels within this fair value gap that you want to keep your eye out for. And essentially what that level is called is the consequent encroachment. And I know that might sound a little bit overwhelming to some of you that have never heard the term before, but I promise it's super easy. It's commonly referred to as CE, and essentially what it is it's the 50% line from the fair value gap's high to the fair value gap's low. So if we take any fib tool or any tool that allows us to mark out 50% of a range or area, we can go from the fair value gap's high to the fair value gap's low right here. And this dashed line that I've marked out is going to be the consequent encroachment, or the 50% line from the fair value gap's high to low. Now, I'm not going to get into deciphering the importance of this level in this episode. That's going to be next episode when we talk about stop placements and when to know when a fair value gap is failing. But essentially what you need to know is that this level is a level of importance, and generally speaking, this is more so a zone or area of importance. So now that we kind of have a base understanding of what a fair value gap actually is, let's go into the charts and take a look at some that we've found ourselves. Okay, so the first example we're going to take a look at here is the same fair value gap that we were looking at last episode when we were talking about market structure shifts. So essentially what we're looking for is for candle 2, because every candle is going to be candle 1. So right now this is candle 1, and we're looking for candle 2 to trade and close above candle 1's high, and that's going to be our first indication that a fair value gap might form. So nothing happens here. This is now candle 1. Nothing happens here that we want. This is now candle 1. And then here we go after this candle has traded above candle 1's high and closed above candle 1's high. We now need to wait for the next candle to see if we're going to come all the way back down and touch this number 1 candle's high, or if we're going to leave a gap in between this candle's high and the new or next candle's low. And as this candle forms and closes, we can see that there is no overlapping wicks from this candle's high to this candle's low, which makes our fair value gap. And this is going to be our consequent encroachment line right in the center here. So what can we expect price to do in this example? Well, if you watched our last video, you know the price shifted structure and then came all the way back into our fair value gap, where we could have found an entry point here, ultimately targeting opposing liquidity. Now, this isn't always going to work. Not all fair value gaps are going to be respected. For example, when we take a look at this fair value gap over here, from this candle's low to this candle's high, why did price not reject right here and ultimately sell off towards lower prices? And the reason for that is because of a liquidity sweep and the way that the algorithm is repricing. Now, that's a little bit more of a complex topic, but just to soothe your curiosity, this level right here is going to be a level of liquidity. And essentially what happened is the algorithm went from a sell algorithm where we were trending lower, swept liquidity, took out stops and stop losses, and then started to push higher and shifted structure. So we are now in a bullish algorithm or a buy algorithm, meaning that bullish fair value gaps are more likely to work and bearish fair value gaps should fail. So lots of people understand fair value gaps and what they actually look like, but they have trouble understanding the last thing that I said. And to rephrase that, when we are in a buy algorithm, or when price is wanting to reach or draw towards a higher price, bullish fair value gaps are going to support price, and bearish fair value gaps are going to fail or act as an easy or low resistance liquidity run for price to run straight through. Vice versa goes for when we're bearish. When we're bearish or we're repricing lower, bullish fair value gaps should fail. As you can see here, we're not supported, and bearish fair value gaps should reject price or act as resistance. When we're in a sell algo or we're trending lower, bearish fair value gaps should act as resistance, and bullish fair value gaps should be disrespected and not show support. As you can see right here, we show no support to this bullish fair value gap, but we do show support to this bearish fair value gap. That not only tells us that we're in a sell algorithm or we're repricing lower, but we should also be able to anticipate this if we understand that price is drawing lower or that we have bearish market structure. So I hope that kind of makes some sense and we didn't get too far ahead of ourselves, but essentially what I'm going to do here is now take a look at a bearish example, and one that we haven't covered before, which is essentially where we have different colored candles here. So if you take a look, and we're looking from left to right, of course, so this is currently candle 1, this green candle. Now some of you might be thinking, okay, we're looking for a bullish fair value gap. It's incorrect here. We actually get this down close candle. So it's going to be candle 2 and candle 1. And candle 2 is below candle 1's low. So we're now looking for candle 3 to not come up to this candle 1's high. And as you can see, candle 3 does not come up to candle 1's high. Therefore, we have this fair value gap here. And if we're expecting price to go lower and we have bearish market structure, this should act as resistance, and we should ultimately sell off from that fair value gap. So I hope that's kind of making some sense now. And just to really drive home the point here, if we take a look at this fair value gap right here that I'm just seeing now, we can see that we have a down close candle that would act as candle 1. This candle here is going to be candle 2, which is also down close or black, and candle 3, which is this candle right here, is a green candle. So not all of the candles need to be the same color, but essentially you can see that this is where we found lots of resistance here before ultimately selling off and going lower. So I want you to just understand that the color of the candle does not necessarily mean anything. The only thing that you need to potentially keep in mind is candle number 2, where you have this big candle in the middle. That's going to be what determines if it's a bearish fair value gap or a bullish fair value gap. For the bearish fair value gap examples, this candle here is going to be black. And for the bullish fair value gap examples, the candle is going to be green. Like in this example here, you have a bullish candle in 1. This is candle number 2 that trades above candle 2's high, and candle 3 fails to trade back to candle 1's high, ultimately creating this fair value gap, which is used as support and ultimately pushes us up to make a new high over here. So I hope that's kind of making some sense for you. We are going to build on fair value gaps in our next episode. We're going to talk about how to know when they're failing, where to place your stop loss, and things like that. So if you do have any questions for now, make sure to let me know in the comment section down below, and I will do my best to answer those. And until next time.